S. Naren. He's with us this morning. Naren, it's great to have you. You know, markets have been floating under this overhang of what's happening on the global front, and a lot of attention is turning to the domestic action and how much conviction there is to really drive this story forward from here. What's your view currently in terms of the way we will move forward? Given that there might be some temporary uncertainty with regards to rising cases, and that news in the forefront. But overall, on the domestic front, how do you see things improving?
Yeah, I think the economy is certainly picking up if you look at it compared to where we were 6 months back or 9 months back. And from that point of view, things are certainly in much better shape. And clearly, one doesn't know how the second wave of COVID, which seems to be focused significantly in Maharashtra, how that shapes up. The reality is that valuations are not what used to be 1 year back. 1 year back when markets were really, really cheap, although there was panic, but valuations were really, really cheap, whereas now markets are not that cheap. So I think clearly we are going to see volatility in the period ahead, and that volatility will continue as long as you have news like COVID and things like that. But the real risk actually comes when US decides that we have to become more hawkish, or they want to stop quantitative easing, or they want to hike rates. And as you can think of, these are all things which are not in the domain that we can predict. And that is the real risk which will finally bring down the market significantly. And it is outside the domain of anyone in India. But from an India angle, I think economy is improving, and earnings should certainly be much better than what we have seen in this 2013 to 20 phase. Because the 2013 to 20 phase was dominated by deflation. And deflation is basically a problem of one person's output. And if you have one person's output price coming down, you have bad earnings. Whereas now you have a situation where so many commodity prices are going up, like steel goes up, aluminum goes up, zinc goes up. So you have a situation where that leads to fantastic earnings, and that's why you'll have a much better earnings period at this point of time than you saw between 2013 to 20. To sum up, I think we are in a different environment than 1 year back. We are going to see volatility, which is the reason why we've been recommending asset allocation and dynamic asset allocation. And the real problems come when the global central banks decide to spoil the party by actually saying hawkish things or doing hawkish things.
Absolutely. What about our own central banks as well, Naren? We've got the policy coming up, although not expecting any great waves or changes or fireworks as such this time around. But, do you see any shift when it comes to policy back home over the next couple of quarters?
Actually, if you look at the statements made, for example, in the monthly bulletin of Reserve Bank of India or the numerous interviews given by the Reserve Bank governor, he is actually telling the markets to be more dovish, and the markets are actually more hawkish than the central bank. So if you look at the business cycle in India and look at the business cycle in, let's say, US, in India, you have credit growth, which is really low. I mean, in my 31 years of working, how many years you have credit growth at 5-6%, 6%? You have a situation where all the top corporates are just deleveraging, and deleveraging. So you have a business cycle in India which is much, much more, I would say, tepid than what you see in US. So I think the central bank has been rightly telling the markets that we have got liquidity, we have bought so much of dollars, and we have got all these things. So please do not worry too much. But the reality is, I think the problem is that all of us are so fixated globally And the global situation is very different because US has pumped so much of money into this entire market. By now there is a new infrastructure bill which is coming out of US. So you have a situation where I think it is the US turn in yields which is also giving rise to this situation at this point of time. And that is the reality. And I would say that, I would not worry so much. Look at the surplus money which is sitting with Reserve Bank at this point of time. As one of my colleagues keeps saying, there is a lot of scope for interest rates to go down actually in various ways in India, because you have so much of surplus money sitting with Reserve Bank at this point of time, earning reverse repo rates, and that can happen, and credit growth is so low, but somehow it doesn't go down. And I would say that India's economic cycle or business cycle is behind the US, and I don't think there is so much scope. We don't see evidence of any exuberance in the Indian business cycle that we have to worry about it at this point of time. We have to worry about the exuberance in the American business cycle. And you see it also if you look at the last 1 week, although it had no Indian equity market impact. But if you look at that whole Don Huang issue, you'll find that a small family office managed to take $30-40 billion of leverage and invested in so many companies, and that caused losses to two banks. And those banks' stocks fell, etc. This is what I read. I don't know much beyond that. And so I believe that it is the exuberance of the US business cycle, which is something which worries us at this point of time. I don't think I worry about the Indian business cycle. Even if you look at the macro in India, you have a situation where current account deficit is hardly there. Inflation is reasonable. You don't have high credit growth. You don't have any evidence of extreme risk-taking. At this point of time, the only risk-taking that I saw was that some of the IPOs saw very high QIP HNI subscriptions, but there also we have seen a few IPOs open below issue price. So I think even that evidence of exuberance will become less at this point of time. So I think we are in a comfortable stage of the Indian business cycle, but not so globally.
Hi, Naren. Naren, while it's impossible to predict the liquidity, the grain of the truth here is that when FIs they sell the market, the back of the market gets broken. And there have been instances, let's say few days in the month of March, plenty of days in the month of Feb, where when FIs have sold, the back of this market has broken. Is that the biggest concern right now? That if the flows they reverse, which they could, we could be staring at a very different market.
Absolutely. I think that is the risk at this point of time, and that is the risk which prompts us to recommend asset allocation and dynamic asset allocation kind of products to investors. Because see, we are living in a globalized world. And in a globalized world, what matters to equity markets is not just local conditions, but also global conditions. And you cannot say I'm living in some isolated market, unconnected to what is happening in the world. And so you are connected to the world, and you can see that finally one day when the Fed decides to become hawkish, you're going to see global markets fall across the world, including India significantly. So that is the risk, and the only way the risk can be addressed is by following an asset allocation approach and a dynamic asset allocation approach, because notwithstanding whatever you can say on the Indian business cycle, the reality is neither is Indian equity valuations dirt cheap at this point of time. So the reality is that you are connected to the global business cycle. You are connected in totally, and we have seen that over a long period of time also. So the truth is that you are connected to this cycle, and that cycle will play out, and you can't say that US will fall, US can fall and India will go up. I don't think we are in that kind of a period ever from now on. I think that period is completely gone, and we have to live with that risk. And that is the situation. I was very happy to see that when that Don Juan event happened, Asian markets did not fall and Indian market did not fall. And that was something which was pleasant for me. But I don't think that is going to be the situation in future. I think in future episodes when that is why I believe that the reality also is that if you are pumped in trillions of dollars, the global central banks have pumped in trillions of dollars. I don't think at some point of time when the trillions of dollars is taken away, you are going to have volatility in Indian equity markets. There has to be a cost to the trillions of dollars that they have put into the economy, and that also will happen. The only way in which all these issues can be handled is by careful asset allocation. And if you are trading directly in equities, by being disciplined yourself. And if you are not capable of being disciplined yourself, there is no choice for you but to go through mutual fund route. Because otherwise, as you would have seen over the last few months, there have been so many periods of time when the markets have been very volatile. It appeared that the markets will keep going down, then suddenly the markets recovered. So I think we are in a framework where you are going to see volatility, and unless you're disciplined, you've got a lot of challenges ahead.
Naren, we understand from your peers and when I speak to some of your counterparts that the pressure on redemption has minimized. It's not that the net inflow is positive, but the numbers what we were looking at, let's say in December and Jan, that in a sense has come down dramatically. What has been the experience at ICICI Prudential? Have redemption pressures come down dramatically?
Impressed by the way Indian investors have been behaving, because last March, frankly, when the markets were panicking, they did not take money, and we got the opportunity to invest aggressively, particularly in our asset allocation kind of strategies. And when the markets went to records and crossed 50,000, they took out money. So I think that level of discipline that people have shown, and I must thank all mutual fund distributors and investors in this whole journey, because that is why I saw that when markets crossed 50,000, we saw redemptions. And when markets crashed or rather corrected in February and March, they actually reduced their redemptions, and we have seen better numbers both in March particularly. And luckily now we have daily data, so what I'm telling you is public information technically. So so what I believe is that it's a very healthy development. And I've seen that this is a positive, if you ask me. And I believe that this is as long as investors take out money when markets rally significantly and invest when markets correct significantly, they're going to have a very good investing experience through mutual funds.
How about thanking media, Naren, for a change? That at least at ET Now I can vouch that we've been big advocaries of buy the fear and sell the greed. Naren, you there?
Yeah, I'm there. Can you hear me?
No, I'm saying how about thanking media? You've thanked distributors, you've thanked investors. How about thanking media? At least at ET Now I can say that we've been big advocaries of buying the fear and selling the greed.
No, I'm sorry. I think in March 2020, you gave me a platform on the day the market fell 10% to communicate to everybody that today is the day to invest. How can I not thank ET Now for it? And I believe that is always the best. ET Now has always been the best investment opportunity, has come out of the fact that you have been very disciplined in telling people to be disciplined all the time as investors. I'm sorry if I have not communicated that clearly.
No, I was looking for a promo line, Naren. Thank you for giving us a promo line and endorsing that, why you like to come on ET Now. Naren, I'm going to talk about a very basic aspect and a term which we've used many a times in the past, which is that in a commodity cycle, wealth creation moves, which is the commodity producers, they get wealthy, the commodity consumers, they lose, and they lose purchasing power. Assuming that we are in a strong patch for commodities, whether it is steel, copper, sugar, cocoa, or even for that matter, coffee, what will happen to the consumer? At what point in time it will start affecting the consumer, and at what point in time it will start affecting some of those haloed consumer stocks which are currently trading at P multiples which are historic high?
As you know, we have always been in the last quite some time in the camp that, all these commodity companies can do very well. And that comes out of our belief that if you have a long period of underinvestment in any commodity, you're going to see those prices go up. And we still believe that if you look at it today, there are hardly any big investments coming out of any commodity industry at this point of time. So you are seeing chronic underinvestment in commodities. In fact, some of the commodities where I see chronic underinvestment includes oil. And that has been my biggest worry at this point of time, that thanks to all these various other things that are happening, even oil is a commodity where there is underinvestment, which is happening. In between shale had overinvestment. But now there is chronic underinvestment even in oil. And this is a big risk. I am a believer clearly that the current cycle resembles the 2002 to 8 cycle, where commodities did well, but the commodity user industry did not do that well. But they did not give bad absolute returns. They gave bad relative returns at some points of time in the cycle. But overall, what I've seen is when commodity industry does well, the economy somehow does well. So during the 2002 to 8 period, if you look, oil went up, but the economy did pretty well at that point of time. And this is something which baffles me. Whereas in the period between 2008 and 20, when oil did badly, although oil doing badly is very good for Indian economy, the economy did not do well. So why is it that the economy tends to do well when commodity does well is something which has baffled me, but somehow I think that inflation is something which is slightly good for the world. And I did not know that till 2008 that deflation is a bad word. And after that, thanks to Ben Bernanke and many of the global central banks, I realized that deflation is a bad word. But I think again, we are in this cycle from 2020 March that we are seeing inflation, and inflation is a slightly good word for the entire world, because somehow inflation leads to more economic activity and people actually sell goods faster. Because the moment you have inflation, take for example, real estate. You look at the kind of real estate deals that have happened in the last 6 months. It has come out of the fact that inflation has come in real estate, and therefore people have just gone ahead and now booked flats or bought flats or done something like that. So I think inflation is good for the for transactions and for advancement of transactions. Deflation is bad for transactions because it tends to delay transactions. This is what I've learned. So I think, yes, commodity users are affected. But I think even in the 2002 to 8 cycle, which saw steel prices shooting up, none of the commodity companies collapsed. And none of the auto companies collapsed. None of the users of auto companies or steel companies like the capital good companies collapsed. So somehow when metal companies do very well and the user companies, they may do relatively badly compared to the metal companies, but nothing much happens to them. They somehow manage, because why metal companies are doing well is because demand is good. So this is what I've learned. So I think, yeah, they will do relatively badly maybe, but I don't think you have to fear what it is. As far as all these consumer companies and all these things are concerned, they look overvalued to me. They have looked overvalued to me 3 years back. They look overvalued to me 1 year back. But they are quality companies, so they tend to be overvalued most of the time. And we, with my kind of investing mindset, I have to look for other stocks which outperform them. So while they are quality companies and they are great companies, I have to find other stocks which can do better than them. Luckily, the last 1 year has been very good for such styles, but we have gone through a period where it was very bad for such styles. But we have come out of it. I hope it continues like this for quite some time.
If I scan through the portfolios which you manage and which you oversee, a underlying thought has been centered around buying into utilities. They are cheap, they are big beneficiaries when interest rates are low. In last 3 months, most of the utility stocks have done rather well, and if at all, you cannot now make a case that interest rates will go down further. So what is the way forward for utilities which normally do well when rates are coming down rather than when rather than when environment is pro inflation?
Actually, we were looking at it recently. What are the stocks where the valuations are very cheap relative to history? And what we came out was utilities is still the cheapest sector relative to history at this point of time. And that continues despite the move in the last 3 months, because you have to look at how it is on a 1 year basis or a 3 year basis. And I believe that, what COVID showed us in the last 1 year is there are things that you can't live without. You can't live without electricity, you can't live without IT, and you can't live without telecom. These are the three things which you can't live without. And that's why I think that utilities have to get re-rated more. They have done well in the last 3 months, but on a 1 year basis, many of the stocks continue to be underperformers. And I think there is scope for them. If you compare utilities, for example, against another sector, which we have liked, metals, metals have drastically outperformed utilities. And I think there is a lot of scope for some of the utility stocks to do much better from where they are at this point of time. And that is how we look at it currently.
Naren, one central argument and one realization for all of us has been the importance of digitization and the relevance of Indian IT companies. The growth what the TCS is indicating, the margin expansion what Infosys has reported, these were impossible if COVID crisis would have not hit us. IT companies are saying that a lot of work which would have got executed in 4 to 5 years is now getting executed in 12 to 18 months. Do you think IT companies are fully valued, or this could be a structural trend rather than a sugar rush?
So I think initially, immediately we thought that this is like 2008 and we were a bit cautious. Then we realized actually what has happened after COVID is that we could have seen a structural change in growth, and that growth could have gone up structurally, because finally at the end of the day, in a WFH framework, and a digitization framework and an e-commerce framework, the kind of investment that every company has to make in technology has gone up significantly. And I believe that the growth rate that we needed to think in the pre-COVID environment and the post-COVID environment for the Indian IT companies, I think we have to agree that the outlook is better now. How much is priced in at this point of time already? Because when we did the same analysis, what we did for utilities, we found that IT is one of the sectors which has got drastically re-rated compared to the pre-COVID period at this point of time. So the question which is complex at this point of time is how much has it already been built is something which we are trying to think about. And maybe some of the companies will give us guidance this month. And once they give the guidance, and we will get an idea of how much is already inbuilt into it and how much is not inbuilt into it. Having said that, it is not just the guidance for this year which is important. It is how much is the long-term growth guidance with change which is going to happen. And there, I think there's a lot of dilemma whether for the next 5 years itself, whether the growth rate for the IT companies have gone up or not. And there's a lot of thinking that is going on in our firm between different people in the firm on how much is the growth rate of the Indian IT sector going up due to what has happened in the last 12 to 18 months. And that is a discussion and analysis which is going on at this point of time.
Okay. Naren, what we saw in the last decade was companies which were reducing debt, companies which were zero debt companies, companies which were extremely focused on higher ROS and higher return on equity did rather well. Could that reverse happen now? Because if the economy is doing well, corporates will have to take risk, they will have to lever their balance sheet. Are we staring at a complete reversal of the market in terms of outperformance and underperformance? Because you know this much more than anyone else, the power of mean reversion and importance of cycles.
Yeah, actually, I have had a view over the last 2 years. What I keep telling my colleagues, bet on solvent leveraged companies. And, there's so many people who said we'll bet on solvent, no leverage companies. And I used to tell them bet on solvent leveraged companies. I never told them to bet on insolvent leverage companies. But the reality is, if you look at the market in the last 1 year, solvent leverage companies have done much better than solvent no leverage companies. And I believe that even today, the solvent leverage companies for the next few years can do much better. Because look at the interest rates at which the solvent leverage companies are borrowing today. It is really mouth-watering to borrow at 3, 4, 5% for the next 1, 2, 3, 4 years. And many of the AAA companies are borrowing at such low interest rates that I still believe that the solvent leverage companies have a huge positive benefit which is coming out of low interest rates. So I think, if there are companies which are just too cash rich and they don't know what to do with the cash, and if for a period of time they were the darlings of the market, I'm not that comfortable. I tell those companies, why don't you return all the money back to the shareholders? Because anyway, you're getting no return on the surplus debt that you're sitting with. Because if you look at it, at least 3 years back, you're getting 7-8% in most of the debt mutual funds and all that you are getting on any of the debt that you are invested in. Today, if you invest in a liquid fund, you get 3%. So why don't you return all that money back to the shareholders themselves? So I think solvent leverage is a much better theme than solvent no leverage at this point of time. And I think companies which do growth, as I keep telling my colleagues, that growth is something which will always be rewarded. This is a world where growth is not easy to get. And that's why if IT companies are going to deliver good growth for the next 5 years, they're going to get very, very good valuations. And that is the reality. And I think we need to recognize that leverage in a limited way, not in an excessive way, is a positive. Leverage in an excessive way may be negative, like what happened to infrastructure companies in 2008, 9, 10. But today, leverage in a limited way, I view it as a positive, and that is the kind of way in which we have been looking at. And last 1 year has been profitable to us in many of the stocks where we've invested in solvent leverage themes.
Okay. Naren, closing comments, last question. Won't extend our appointment beyond that. I'm asking a very basic question, Naren. Market price is EPS into PE. And for the benefit of our viewers, I'll say it again. Market price, which is a stock price, is a function of EPS into PE. So Naren, for next 3 years, which end of the market do you think could surprise us with EPS, which is earnings? And which end of the market do you think could surprise us with EPS expansion? I mean, both happens, then we have a multi-bagger. But we both know that in the market, sometimes EPS goes higher, sometimes PE goes higher. It's rare that EPS and P multiple, they go up together.
I think clearly the cyclical part of the market is going to surprise us on EPS. And beauty, what I've seen is that once there are sectors which surprise us on EPS for a few years, PE also expands. So you might have both. But all these parties can go down the day the global central banks say, we want to spoil the party, now we're going to increase interest rates. Or we're going to take away all the money that we have pumped in into the entire economy by putting all those $1 trillion we're going to take away. But so I believe that it is the global central banks which are going to finally play spoil sport to all this. But I must thank, I want to reiterate, I think the last 1 year has been exceptional. And I must thank all the channels like ET Now for actually preventing panic at the bottom and ensuring people stay invested at the bottom. And all the people who worked so hard in COVID, I would have never imagined the last financial year that for the whole year, despite COVID, we managed to keep all our institutions active, alive, and we had such a buoyant market, both in equity and debt. For that, I have to thank everyone, whether it is the exchanges, whether it is how the regulator supported by making us manage to do everything out of home and various other things, and all the employees of so many institutions. I think it's been an amazing year. I could have never imagined such a year in my life. I must thank all of you for it.
Well, thank you, Naren, for again being part of 18-hour programming, and thank you for coming and educating and advising our viewers and your unit holders and investors at these turning moments. Same time last year there was gloom and doom, and right now there is outright, I won't say outright, but there is definitely optimism and positivity which is back. So have a great day ahead, Naren. It's a long weekend. Enjoy your weekend as well.